This podcast is brought to you by Top, the stories of top companies. Disclaimer. This AI-generated content is for informational purposes only and should not be considered as investment advice. Circle Internet Group, the rise of the digital dollar. Picture this. It's March 10th, 2023, and Jeremy Allaire, CEO of Circle, is watching his company's $40 billion stablecoin empire teeter on the edge of disaster. Silicon Valley Bank, holding $3.3 billion of Circle's reserves, has just collapsed. The crypto community is in panic mode. USDC, the trustworthy stablecoin that powers much of decentralized finance, briefly depegs from its dollar parity, trading as low as 87 cents. In boardrooms across Boston and San Francisco, Circle's executives are working around the clock, fielding calls from regulators, investors, and terrified customers. Yet, just over 2 years later, Circle would go public at a $56 billion valuation, with its stock price soaring 167% on the first day of trading, one of the most spectacular IPO performances in recent memory. How did a company that pivoted away from Bitcoin become crypto's most trusted institution? How did they build what is essentially a money printer that generated $1.68 billion in revenue in 2024 simply by holding other people's dollars? This is the story of Circle Internet Group, a company that started with the dream of making money, move like email, survived multiple crypto winters, navigated regulatory minefields, and emerged as the bridge between traditional finance and the digital asset revolution. It's a tale of trust, regulatory arbitrage, and building financial rails for the internet age. Along the way, we'll explore how Circle transformed from a consumer Bitcoin wallet into the infrastructure powering the digital dollar, why they walked away from a $400 million crypto exchange acquisition, and how they turned the boring business of holding cash reserves into one of the most valuable fintech companies in the world.
The year was 2013, and Bitcoin was having its first real moment in the sun. The cryptocurrency had surged from $13 to over $1,000 before crashing back down. A preview of the volatility that would define the space for years to come. In Boston, two entrepreneurs were watching this chaos with a different vision. What if, instead of speculation, cryptocurrency could actually become useful for everyday payments? Jeremy Allaire wasn't your typical crypto anarchist. The serial entrepreneur had already built and sold Brightcove, a video platform company, for hundreds of millions. His co-founder, Sean Neville, brought deep technical expertise from their previous ventures together. When they founded Circle in October 2013, their mission statement was elegantly simple. Make money as easy to move and use as email, transcending borders and banking hours with the efficiency of the internet. The early Circle product was a consumer-facing Bitcoin wallet and payment app. Think Venmo, but powered by cryptocurrency. Users could send money to friends, pay for goods, all while Circle handled the messy conversion between dollars and Bitcoin in the background. The pitch to investors was compelling. Circle would be the user-friendly gateway that brought Bitcoin to the masses. Venture capital poured in from the beginning. Between 2013 and 2016, the company raised over $135 million across 4 funding rounds, notably including a $50 million investment led by Goldman Sachs. The significance of that Goldman investment can't be overstated. As the New York Times reporter Nathaniel Popper wrote, that the Goldman Sachs investment should help solidify Bitcoin's reputation as a technology that serious financial firms can work with. This wasn't just funding. It was validation from the heart of Wall Street. By 2015, Circle had achieved another crucial milestone. Circle became the first company to receive a BIT license from the New York State Department of Financial Services. And by April 2016, it was also the first company to gain approval for virtual currency operations from the British government. While competitors operated in regulatory gray zones, Circle was collecting licenses like Boy Scout badges. But something wasn't working. Despite the prestigious investors and regulatory approvals, consumer adoption remained sluggish. Bitcoin's volatility made it impractical for everyday payments. Imagine buying coffee with something that could double or halve in value by lunchtime. The regulatory burden of operating a Bitcoin exchange in the US was crushing. And perhaps most importantly, Circle found itself competing not with traditional banks, but with slick Silicon Valley payment apps like Venmo that didn't require users to understand blockchain technology. The pivot came gradually, then suddenly. Circle repositioned itself as a social payments company, essentially trying to beat Venmo at its own game while using cryptocurrency rails behind the scenes. But by December 2016, the Circle app stopped supporting the exchange of Bitcoin but still allows money transfers. The original Bitcoin dream was dead. Or was it? What looked like failure was actually the company learning a crucial lesson. The problem wasn't the technology, it was the volatility. What the market needed wasn't a better Bitcoin wallet, it needed a digital dollar.
The year 2017 found Circle at a crossroads. The consumer payments pivot had failed to gain traction, and the company faced an existential question: what was their actual competitive advantage? The answer emerged from observing the crypto market's fundamental problem. As internal documents later revealed, with increasing regulatory scrutiny and the inherent volatility of cryptocurrencies like Bitcoin, it became clear that there was a strong need for a digital asset that held stable value. Enter the partnership that would change everything. On May 15, 2018, Circle raised $110 million in venture capital to create USD Coin, USDC. But this wasn't a solo venture. The underlying technology behind the USDC was developed collaboratively between Coinbase and Circle in our capacity as partners and co-founders of the New Center Consortium in 2018. The brilliance of USDC wasn't in technological innovation. Stablecoins already existed, with Tether dominating the market. The genius was in positioning. While Tether operated in regulatory shadows with opaque reserves and questionable banking relationships, Circle and Coinbase built USDC as the clean stablecoin. One USDC is a one-bond-one representation of a US dollar on the Ethereum blockchain. Each USDC is 100% collateralized by a corresponding USD held in accounts subject to regular public reporting of reserves. The timing was perfect. DeFi was beginning to emerge, and developers needed a stable unit of account to build lending protocols, decentralized exchanges, and yield farming strategies. The advantage of a blockchain-based digital dollar like USDC is easier to program with, to send quickly, to use in dApps, and to store locally than traditional bank account-based dollars. Circle announced USDC on May 15, 2018, and it was subsequently launched in September of the same year by Center. Within weeks, the adoption was explosive. In its first few weeks, USD Coin has already gained broad industry support from more than 40 companies, including wallets, exchanges, custodians, dApps, and other leading firms. What set USDC apart wasn't just transparency. It was the commitment to working within the system rather than against it. Circle already had the BIT license, money transmitter licenses in multiple states, and relationships with legitimate banks. They weren't trying to overthrow the financial system, they were upgrading it. The Center Consortium structure was particularly clever. By creating a separate governance entity with Coinbase, Circle positioned USDC as an industry standard rather than a proprietary product. This would prove crucial for adoption. Developers and institutions were more comfortable building on infrastructure that wasn't controlled by a single company. By 2019, USDC was firmly established as the second largest stablecoin, growing from zero to billions in circulation in less than a year. The infrastructure play had worked. Circle was no longer trying to compete with Venmo or replace Bitcoin. They had become the plumbing for the new financial system.
February 26, 2018, started like any other Monday in crypto, until Circle dropped a bombshell. They had purchased the Poloniex cryptocurrency exchange for $400 million. In crypto circles, this was the equivalent of Goldman Sachs buying the NYSE. Poloniex wasn't just any exchange. It was one of the pioneers, the first exchange to reach $1 billion in daily volume, and the platform that had given Ethereum its first real liquidity. The strategic rationale seemed bulletproof. Circle was building a full-stack crypto financial services company. USDC for stable value, Circle Trade for institutional liquidity, Circle Pay for consumer payments, and now Poloniex for the global token marketplace. As Jeremy Allaire and Sean Neville wrote in their announcement blog, Now, Poloniex addresses another key element of Circle's product foundation, an open, global token marketplace. The timing looked perfect. Crypto was in full bull market mode, with total market cap exploding from $20 billion to $500 billion in just a year. Circle Trade manages $2 billion a month in transactions and generated $60 million in revenue in just 3 months, according to Fortune. Adding Poloniex would instantly make Circle competitive with Coinbase in terms of revenue. But behind the scenes, the acquisition was already showing cracks. Poloniex achieved momentum and success with rocket ship velocity, a magnificent accomplishment, but one that also comes with whiplash, Circle's founders admitted. The exchange had grown so fast it could barely keep up with customer support, compliance requirements, and technical infrastructure. Even more problematic were the regulatory skeletons in Poloniex's closet. Unknown to Circle at the time of acquisition, in 2017, before Circle acquired Poloniex, the SEC filed a complaint against Poloniex for the trading of cryptocurrencies that may be characterized as securities. The exchange had also potentially violated sanctions by allowing users from restricted countries to trade. In October 2018, it was announced that Circle planned to acquire Seed Invest, a crowdfunding platform that would allow Circle to offer security tokens, a sign they were doubling down on the exchange strategy. But internally, the Poloniex integration was becoming a nightmare. The exchange's code was held together with digital duct tape, its compliance systems were inadequate for U.S. regulations, and worst of all, the crypto market was entering a brutal bear market. The end came swiftly. In October 2019, Circle and Poloniex announced their split, with Poloniex establishing itself as a new company named Polo Digital Asset. The financial damage was staggering. Circle lost $156 million through its acquisition and subsequent sale of Poloniex only 18 months later. But the pain didn't end with the sale. Circle has set aside more than $10.4 million to settle the SEC case inherited from Poloniex. They also faced $1.1 million to $2.8 million to OFAC for sanctions violations. The Poloniex debacle taught Circle a brutal lesson about the dangers of empire building in crypto. You couldn't just buy your way to dominance, especially not when the assets you were acquiring came with regulatory time bombs. The company that had been so careful about compliance with its own products had nearly been destroyed by someone else's shortcuts. As 2019 ended, Circle made a crucial strategic decision. Focus. They would stop trying to be everything to everyone and instead double down on what was working, USDC and infrastructure. The consumer products would be shut down, the exchange ambitions abandoned. It was time to become the plumbing, not the faucet.
The pandemic changed everything for Circle and for digital finance. As the world went into lockdown in March 2020, traditional financial systems creaked under the strain. Wire transfers took days, international payments became nearly impossible, and suddenly the promise of instant, borderless money movement wasn't theoretical anymore, it was essential. But the real catalyst came from an unexpected source. DeFi summer. A year ago, there was just $800 million in value locked in DeFi smart contracts, and today has mushroomed to over $23 billion. USDC grew 800% last year and ended the year literally on December 31st around 4 billion USDC. The explosion wasn't just about numbers, it was about use cases. DeFi summer happened. The explosion in DeFi's popularity, led by protocols like Uniswap, Compound, Aave, and Maker, created an explosion in the developer ecosystem and interest in embedding USDC in all of the new things they were creating. Suddenly, USDC wasn't just a stable store of value. It was the lifeblood of an entirely new financial system. Circle made a crucial strategic decision during this period, shifted focus from retail-facing products to building infrastructure for institutional clients and developers, including APIs for payments, treasury management, and global money movement. This wasn't glamorous work, no consumer app, no viral marketing campaigns, just APIs, documentation, and enterprise sales. But it was exactly what the market needed. In May 2021, with USDC's market cap just above $20 billion, Circle announced a $440 million funding round from Fidelity, FTX, Digital Currency Group, and more. The investor list read like a who's who of both crypto and traditional finance. This wasn't venture capital betting on potential anymore. This was strategic investment in proven infrastructure. Then came April 2022. Circle Internet Financial announced an agreement for a $400 million funding round with investments from BlackRock, Fidelity Investments, Marshall Wace LLP, Finn Capital. But this wasn't just about the money. BlackRock has entered into a broader strategic partnership with Circle, which includes exploring capital market applications for USDC and serving as a primary asset manager of USDC cash reserves. The partnership with BlackRock was transformative. The world's largest asset manager wasn't just investing, they were legitimizing. The portfolio of the Circle Reserve Fund is custodied at the Bank of New York Mellon and is managed by BlackRock. Suddenly, USDC reserves were being managed by the same firm that manages trillions for pension funds and sovereign wealth funds. The momentum seemed unstoppable. Circle announced plans to go public via SPAC merger with Concord Acquisition Corp in a $4.5 billion deal. Management was projecting continued hypergrowth, with Jeremy Allaire promising 40% compound annual growth rate through the cycle for USDC circulation. Then came the moment that nearly destroyed everything Circle had built. On March 10th, 2023, USDC Stablecoin announced that $3.3 billion of its $40 billion coin reserves were held at Silicon Valley Bank when it collapsed. The news hit like a thunderbolt. Circle has $3.3 billion in reserves tied up at SVB. This is money backing the value of USDC, and if it was to be lost as part of SVB's failure, it would mean a financial hit for Circle. The market's reaction was swift and brutal. By 2 a.m. on March 11th, just a few hours after Circle's announcement, USDC's value had plummeted to 87 cents. The safe stablecoin that was supposed to always be worth exactly $1 was suddenly trading at a 13% discount. Panic spread through crypto markets as traders rushed to dump USDC for anything else. Bitcoin, Ethereum, even competitor stablecoins. The irony was crushing. Circle had done everything right. Transparent reserves, regulatory compliance, partnerships with blue-chip financial institutions. Yet they were brought to the brink by the failure of a traditional bank, the very system they were supposed to be improving upon. But the crisis also revealed Circle's resilience and the strength of its relationships. The FDIC, recognizing the broader implications of the situation, made an exceptional decision to waive the standard $250,000 insurance limit on deposits at SVB. By Monday morning, Jeremy Allaire could announce that 100% of deposits from SVB are secure and will be available at banking open tomorrow. The recovery was as swift as the collapse. USDC rapidly regained its $1 peg, but the scars remained. USDC and Tether nearly reached parity in 2022, but USDC declined, coinciding with the collapse of Silicon Valley Bank. Trust, once broken, takes time to rebuild. Circle's response was immediate and comprehensive. All of the cash held as reserve has since been parked with the Bank of New York Mellon Corporation. No more concentration risk, no more single points of failure. By late 2023, the company announced it had a $1 billion cash cushion, a war chest to ensure they could weather any future storm. The SVB crisis marked a turning point for Circle. They had survived their near-death experience and emerged stronger, but also humbler. The company that had once dreamed of revolutionizing payments now understood that building financial infrastructure meant managing not just technological risks, but traditional financial ones as well.
In January 2024, the company filed a confidential S-1 with the Securities and Exchange Commission. After years of false starts, the abandoned SBAC merger, the SVB crisis, Circle was finally ready to face public market scrutiny. But the path wouldn't be smooth. April 2025 brought an unexpected twist. Ripple Labs offered to acquire Circle for $4.5 billion, a bid that was rejected as too low. The offer was fascinating for what it revealed about Circle's confidence. Here was a company that had nearly collapsed just 2 years earlier, turning down billions because they believed they were worth more. The rejection made sense when you looked at the numbers. Circle had earlier pursued a SPAC merger at a $9 billion valuation. Although that deal fell through, USDC's market cap and Circle's revenue have continued to grow since then. With USDC circulation valued at $61.5 billion and Circle reporting $1.68 billion in yearly revenues, Ripple's offer valued the company at roughly 3 times revenue, a low multiple for a high-growth fintech leader. Finally, on June 5th, 2025, the moment arrived. Circle priced its IPO at $31 per share, above the expected range of $24 to $26, giving it a market value of $6.8 billion. The company raised $1.1 billion, valuing the company at $6.9 billion, less than the abandoned SPAC valuation, but still a remarkable achievement given the journey. What happened next was extraordinary. Shares jumped to $95, closed at $82.84, a 167% gain on the first day. By the close of trading on June 6th, Circle's stock had reached $107.50, giving the company a market cap of $22 billion. The spectacular first-day pop came with controversy. The $1.76 billion shortfall ranks 7th largest for all IPOs since 1980, according to University of Florida professor Jay Ritter. Had the shares fetched the $107.50 close on June 6th, instead of the $31 paid in the presale, the company and insiders combined would have collected $4.144 billion. Hence, as of the second day of trading, the IPO had left a staggering $3 billion on the table. Wall Street had done what Wall Street does, priced the IPO low enough to ensure a massive first-day gain for institutional clients. For every $1 going to the sellers, $3 in two-day gains flowed to the underwriters' Wall Street clients as a windfall. It was a bitter lesson in the realities of public markets, even for a company as sophisticated as Circle. By June 24th, Circle's market cap had reached $56 billion, up 700% from IPO price. The market was valuing Circle at 215x 2025 earnings and 24x revenue. Nosebleed valuations that reflected both the promise of stablecoins and the froth in crypto markets. Jeremy Allaire, ringing the opening bell at the New York Stock Exchange, must have felt a mix of triumph and irony. The company that started as a Bitcoin wallet, pivoted to social payments, nearly died in a banking crisis, and left billions on the table in its IPO was now one of the most valuable fintech companies in the world. The journey to becoming the digital dollar had been anything but stable.
The genius of Circle's business model is its simplicity. While crypto bros chase complex DeFi yields and venture capitalists fund elaborate blockchain infrastructure plays, Circle makes money the old-fashioned way, by holding other people's cash and earning interest on it. Here's how the money machine works. Circle earns interest on the cash and cash equivalents held as reserves for USDC, typically placed in low-risk interest-bearing accounts or invested in short-term U.S. Treasury securities. When interest rates were near zeros, this wasn't particularly lucrative. But as the Federal Reserve hiked rates to combat inflation, Circle's revenue exploded. The numbers tell the story. Q2 2025 results. Revenue rose to $658.1 million from $430 million year over year, 53% increase. For the full year 2024, the company generated $156 million net income on $1.68 billion revenue. That's a 9.3% net margin for what is essentially a custody business with minimal operational complexity. The reserves themselves have become increasingly conservative. The portfolio of the Circle Reserve Fund is custodied at the Bank of New York Mellon and is managed by BlackRock. The majority of the USDC reserve is invested in the Circle Reserve Fund, USDXX, an SEC-registered 2A7 government money market fund. No commercial paper, no corporate bonds, no risky assets, just U.S. government securities and cash. This conservative approach is Circle's moat. While competitors like Tether generate higher yields by taking more risk with their reserves, Circle has chosen transparency and safety. Monthly attestations from Grant Thornton, daily reporting from BlackRock, and full regulatory compliance create trust. And trust is everything in stablecoins. The network effects are powerful. As USDC circulation grew 90% year over year to $61.3 billion, each new dollar of USDC creates more liquidity, which attracts more users, which creates more demand for USDC. It's a virtuous cycle that's hard to break once established. But the real genius is in the distribution model. Circle doesn't just rely on direct customers. Through partnerships with exchanges, wallets, and payment platforms, USDC is available to over 500 million end users. Each of these partners becomes a distribution channel, spreading USDC throughout the crypto ecosystem without Circle having to acquire customers directly. The regulatory moat is equally important. Circle holds licenses in 46 U.S. states, has the New York BIT license, and achieved MiCA compliance in Europe. Each license is expensive and time-consuming to obtain. For a competitor to match Circle's regulatory footprint would take years and millions of dollars, time during which Circle continues to grow and strengthen its position. Revenue sharing with partners adds complexity but also stability. Coinbase receives 50% of the residual payment base, a portion of revenue explicitly derived from reserves backing Circle's flagship stablecoin. While this reduces Circle's margins, it also aligns incentives with one of crypto's most powerful players. The model scales beautifully. Adding another billion in USDC circulation requires minimal additional operational cost. The same systems, the same compliance, the same reserves management can handle $100 billion as easily as $10 billion. Every additional dollar of USDC is almost pure profit margin. Yet there are vulnerabilities. Interest rate sensitivity means that when rates fall, so does revenue. A return to zero interest rate policy would devastate margins. Competition from central bank digital currencies could eliminate the need for private stablecoins entirely. And concentration risk remains. If BlackRock or BNY Mellon faced issues, Circle would be back in crisis mode. Still, for now, Circle has built one of the most elegant business models in crypto, turning the boring necessity of holding dollars into a multi-billion-dollar revenue stream. They're not trying to revolutionize money anymore. They're just making money from money itself.
In the stablecoin wars, there's Tether, there's Circle, and then there's everyone else fighting for scraps. Tether USDT remains the undisputed king. As the issuer of USDT, one of the largest stablecoins by market capitalization, operates similarly to USDC but has different operational and reserve management practices. The numbers are staggering. Tether holds the top spot in the stablecoin market with a market cap of about $160 billion and representing over 60% of the total stablecoin market. Meanwhile, USDC makes up 26% of dollar-backed stablecoin market versus Tether's 67%. The dominance gap is both Circle's greatest challenge and its opportunity. Tether got there first, launching in 2014, compared to USDC's 2018 debut. That 4-year head start created network effects that are nearly impossible to overcome. Every exchange lists USDT, every trader knows it. Every DeFi protocol supports it. But here's where it gets interesting. According to data compiled by Visa, USDC overtook Tether in stablecoin transaction volume in April 2024. Volume tells a different story than market cap. While Tether dominates in size, USDC is increasingly the stablecoin of choice for actual transactions, particularly in the United States and among institutional users. The regulatory divide is stark. While Circle became the first global stablecoin issuer to receive regulatory approval under Europe's MiCA in July 2024, Tether has repeatedly criticized some MiCA regulation aspects, explicitly refusing to comply with the framework in Europe. This creates a fascinating dynamic. Tether operates in regulatory gray zones, but maintains dominance through sheer liquidity, while Circle sacrifices some growth for regulatory clarity. The market is also seeing new entrants that threaten both incumbents. Paxos, with its PYUSD partnership with PayPal, bringing a market cap of about $960 million. Ripple's RLUSD has grown to around $600 million. Even traditional finance is getting involved, with banks exploring their own stablecoins. MakerDAO's DAI represents a different threat, a decentralized stablecoin that doesn't require trust in any company. While smaller at around $5 billion in market cap, DAI's censorship resistance appeals to crypto purists who view both USDC and USDT as too centralized. The geographical split is revealing. USDC has the highest transaction volume for stablecoins, despite having a smaller market capitalization than USDT. Analysts suggest that USDC is used more often in the United States for transactions, while USDT is used more often outside of the US as a store of value. In emerging markets where dollar access is restricted, Tether's lower compliance standards actually become an advantage. Recent trends show the competitive dynamics shifting. The stablecoin market cap soared 15% in 2025 to a record $233 billion, with USDC fueling much of the growth by adding $16 billion compared to USDT's $7 billion increase. Circle is gaining ground, but from a much smaller base. The profitability comparison is illuminating. Tether, with its larger reserves and potentially higher-yielding assets, likely generates more absolute profit. But Circle's transparency means we actually know their numbers, while Tether's remain opaque. This transparency gap itself becomes a competitive factor. Institutional investors prefer knowing where their money sits. The endgame remains unclear. Will regulatory pressure eventually force Tether to become more like Circle, eliminating their competitive advantage? Will Circle's compliance focus eventually win as crypto goes mainstream? Or will both be disrupted by central bank digital currencies that make private stablecoins obsolete? For now, the market has room for both approaches. Tether for traders who prioritize liquidity and global access, Circle for institutions and users who value regulatory certainty. It's not a winner-take-all market. Yet.
The future of Circle isn't just about maintaining USDC's position. It's about building the rails for an entirely new financial system. The company's strategic bets reveal an ambition that goes far beyond stablecoins. At the center of Circle's future is Arc blockchain, a new proprietary blockchain designed to be a network for stablecoin payments, FX, and capital markets applications. This isn't just another Layer 1 blockchain trying to compete with Ethereum. Arc is purpose-built for financial applications, optimized for the specific needs of moving money rather than general computation. The technical specifications are impressive. Sub-second finality, negligible transaction costs, and native compliance features. But the real innovation is in the business model. Arc won't compete for DeFi users or NFT traders. It's designed for banks, payment companies, and financial institutions that need blockchain's efficiency but can't tolerate its current complexity. Circle Gateway represents another strategic bet, provides instant cross-chain liquidity for USDC, eliminating the need for bridging. In the current multi-chain world, moving assets between blockchains is slow, expensive, and risky. Gateway solves this by making USDC fungible across chains. Deposit on Ethereum, withdraw on Solana, with Circle handling the complexity behind the scenes. The Cross-Chain Transfer Protocol, CCTP, takes this further. CCTP has now facilitated more than $20 billion in USDC transfers, enabling developers to build applications that work seamlessly across multiple blockchains. This positions Circle not just as a stablecoin issuer, but as crucial infrastructure for the multi-chain future. In 2023, the company released a protocol that enables users to move USDC between blockchains. It also unveiled a programmable Web3 wallet platform. These aren't consumer products. They're building blocks for other companies to create financial services. Circle is becoming the AWS of digital dollars, providing the infrastructure others build upon. International expansion represents perhaps the biggest opportunity. URC. Euro-backed stablecoin with MiCA compliance has already become the largest Euro-backed stablecoin by total circulation and surpassed $1 billion in weekly transfer volume. This isn't just about replicating USDC and euros. It's about creating a global network of interoperable digital currencies. The vision extends to emerging markets, where stablecoins solve real problems. In countries with volatile currencies or limited banking access, USDC provides a stable store of value and connection to the global economy. USDC empowers unbanked and underbanked populations, providing secure, low-cost access to digital dollars across 180-plus countries. Circle's partnership strategy has evolved from desperate, post-SVB crisis, to deliberate. Recent partnerships with major payment processors, banks, and fintech companies aren't just about distribution. They're about embedding USDC into the fabric of global commerce. When MasterCard or Visa integrates USDC, it's not an experiment anymore. It's infrastructure. The regulatory strategy is equally ambitious. Rather than waiting for rules, Circle is helping write them. The company's executives regularly testify before Congress, contribute to regulatory frameworks, and work with central banks on CBDC pilots. They're not trying to avoid regulation. They're trying to shape it. But the most radical initiative might be the simplest, making crypto invisible. Circle's APIs and SDKs abstract away blockchain complexity. Developers can add digital dollar functionality without understanding smart contracts or managing private keys. Users can send money globally without knowing they're using crypto. This invisibility strategy reflects a mature understanding of technology adoption. The internet didn't succeed because people understood TCP/IP. It succeeded when the protocol became invisible. Email users don't think about SMTP. Circle is trying to make blockchain equally invisible. The risks are substantial. ARC could fail to gain adoption in a world already saturated with blockchains. EURC faces competition from potential ECB digital euro. Cross-chain protocols introduce new security vulnerabilities. And the push for invisibility might reduce the very transparency that makes blockchain valuable. Yet the potential is transformative. If Circle's bets pay off, they won't just be a stablecoin company. They'll be the foundational infrastructure for a new financial system. Every international payment, every cross-border transaction, every movement of value could flow through Circle's rails. The strategy is clear. Don't just issue digital dollars. Become the indispensable infrastructure that makes digital dollars useful. It's ambitious, risky, and exactly what you'd expect from a company that's already survived multiple near-death experiences.
Circle's journey from Bitcoin wallet to $56 billion public company offers a masterclass in strategic pivoting, regulatory navigation, and building trust in trustless systems. The lessons extend far beyond crypto. The power of regulatory arbitrage. Circle's greatest insight wasn't technological, it was regulatory. While competitors operated in legal gray zones to maximize growth, Circle chose the harder path of compliance. This seemed foolish when Tether was growing faster by ignoring rules. But when institutions arrived and regulators cracked down, Circle's licenses became a moat. The lesson: in nascent industries, regulatory arbitrage can be more valuable than technological advantage. Being the boring, compliant option becomes exciting when it's the only option institutions can touch. Pivoting versus perseverance. Circle pivoted 4 times. Bitcoin wallet to payments app to exchange operator to stablecoin infrastructure. Each pivot looked like failure but was actually refinement. They weren't abandoning their vision of frictionless value transfer, they were finding the right vehicle. The key insight: your mission can stay constant while your method evolves. Circle's mission never changed. Making money move like information. Only the implementation changed. Building trust in trustless systems. The crypto ethos says, don't trust, verify. Circle said, trust, but we'll help you verify. Monthly attestations, blue-chip partnerships, regulatory compliance, all theater designed to make bits feel like dollars. This paradox reveals a deeper truth. Even trustless systems need trusted interfaces. Someone has to be the adult in the room. Circle chose to be boring so others could be revolutionary. The importance of banking relationships. The SVB crisis taught a brutal lesson. In crypto, you're only as strong as your banking partners. Circle nearly died not because of smart contract bugs or hacking, but because a traditional bank failed. The learning: when building bridges between old and new systems, the old system's failures become your failures. Diversification isn't just about assets, it's about counterparties. Network effects in financial infrastructure. USDC's growth demonstrates powerful network effects. Each new user makes the network more valuable for existing users. Each new integration creates demand for more integrations. But Circle's genius was recognizing they didn't need to own the network, just be essential to it. By making USDC freely integrated, they sacrificed control for ubiquity. Why timing matters. Circle tried consumer payments too early, bought an exchange at the peak, but nailed stablecoins at the perfect moment. The lesson isn't about predicting timing, it's about surviving long enough to catch the right wave. Circle's real skill was staying alive through multiple crypto winters until the market was ready for their solution. Capital allocation lessons. The Poloniex acquisition was a $156 million mistake. The BlackRock partnership was transformative. The difference? Poloniex was empire building, trying to own the full stack. BlackRock was infrastructure building and becoming essential plumbing. The lesson: in platform businesses, being the platform beats owning everything on it. The hidden value of compliance costs? Circle spends millions on licenses, audits, and compliance infrastructure that generates no direct revenue. But this waste became their moat. Competitors can copy code but can't copy compliance. In regulated industries, your cost structure can be your competitive advantage. When to accept dilution? Circle left $3 billion on the table in their IPO. Management was diluted repeatedly through multiple funding rounds. Yet founders still own significant stakes in a $56 billion company. The lesson? Dilution that ensures survival and scale beats concentration in a failed venture. Own a smaller piece of a bigger pie. The power of patience in negotiations. Rejecting Ripple's $5 billion offer took courage when the company had struggled for years. Waiting for the right public market window took patience. The lesson: when you have strategic assets, USDC, licenses, partnerships, time is on your side. Don't sell in weakness, wait for strength. Building during downturns. Circle's biggest advances came during crypto winters. They launched USDC during the 2018 bear market, built infrastructure during the 2022 collapse, and prepared for IPO during regulatory uncertainty. The lesson: when others retreat, you can advance. Downturns eliminate weak competition and create opportunity for strong operators. For investors, Circle teaches different lessons. Valuation discipline. At 215x earnings, Circle requires perfect execution to justify its valuation. The lesson: great companies aren't always great investments. Price matters, even for category leaders. Regulatory change as catalyst. Circle's value inflection points aligned with regulatory clarity, not technological breakthroughs. Watch regulation, not just innovation. Infrastructure over applications. The big money in new technologies often isn't in consumer applications, but in boring infrastructure. Circle makes money from holding money, unsexy but essential. The meta lesson might be the most important. In technology transitions, the winners aren't always the most innovative or the first movers. They're the ones who correctly identify what the market actually needs versus what it thinks it wants. Circle succeeded not by giving users better Bitcoin, but by giving them better dollars.
The bull case. The optimists see Circle as the J.P. Morgan of the digital age, an essential financial institution that happens to use blockchain instead of mainframes. The bull case rests on several powerful trends converging. First, regulatory clarity is finally arriving. The U.S. appears ready to pass comprehensive stablecoin legislation that would essentially mandate Circle's approach: full reserves, regular audits, regulatory oversight. When the rules match your existing operations, you win by default. Circle has spent years and millions preparing for regulations that competitors will scramble to meet. Management's projection of 40% compound annual growth rate through the cycle for USDC circulation seems conservative given recent momentum. USDC circulation grew 90% year over year to $61.3 billion. And that's before clear regulations, before institutional adoption at scale, before stablecoins become mundane. If stablecoins capture even 1% of global payment volume, USDC could reach $500 billion in circulation. The institutional pipeline is massive. Every major bank is exploring stablecoins. Payment processors are integrating USDC. Corporations are considering stablecoin treasuries. When BlackRock, Fidelity, and BNY Mellon are your partners, not your competitors, you're positioned to capture the institutional wave. Network effects are accelerating. USDC is now available on 24 blockchain networks and accessible to 500 million users. Each new integration makes the next one more valuable. It's the same dynamic that made Visa and MasterCard unassailable. Ubiquity becomes its own moat. The bear case also underestimates Circle's expansion potential. EURC is already the largest euro stablecoin. Similar products for yen, pounds, and yuan could follow. If Circle captures similar market share in other currencies, the opportunity multiplies. Interest rates provide a tailwind. Even modest rates generate billions in revenue on current reserves. If USDC reaches $200 billion in circulation with 3% rates, that's $6 billion in annual revenue with minimal marginal costs. Finally, the bull case sees stablecoins not as a crypto phenomenon, but as the future of money itself. Instant, global, programmable, transparent. These aren't features, they're requirements for modern finance. Circle isn't competing with other stablecoins. They're replacing the entire correspondent banking system. The bear case. The skeptics see a house of cards built on regulatory quicksand and priced for perfection. The bear case starts with valuation. Circle trades at 215x 2025 earnings, 24x revenue. These multiples assume flawless execution and massive growth. Any stumble could trigger a violent repricing. Tether's dominance seems unbreakable. Despite regulatory concerns, despite opacity, despite everything, Tether keeps growing. They have 67% market share versus Circle's 26%. In finance, liquidity is everything, and Tether has it. Circle might be the better product that loses to the good enough incumbent. Competition is intensifying from every direction. PayPal has PYUSD, Ripple has RLUSD. Every major bank is developing stablecoins. When JP Morgan launches a stablecoin, why would institutions use USDC? Circle's first mover advantage in compliant stablecoins is evaporating. The business model is fragile. Circle is essentially a levered bet on interest rates. When rates were zero, they barely survived. If rates return to zero, not impossible given economic uncertainties, revenue collapses. A business that depends entirely on monetary policy isn't a business. It's a macro bet. CBDCs represent an existential threat. Why would governments allow private companies to issue digital versions of their currencies? When the Federal Reserve launches a digital dollar, USDC becomes obsolete overnight. China's digital yuan, Europe's digital euro. Every CBDC is a dagger aimed at Circle's heart. The bear case also questions stablecoin necessity. Critics argue they're a solution in search of a problem. International payments are improving through traditional channels. Real-time payment systems are launching globally. Perhaps stablecoins are just a bridge technology, useful during crypto speculation but unnecessary in mature digital finance. Concentration risk remains severe despite diversification efforts. Coinbase still drives significant volume. BlackRock manages reserves. BNY Mellon provides custody. Any of these relationships failing could trigger another crisis. The revenue sharing with Coinbase is particularly concerning, giving away 50% of residual revenue to a partner who could eventually compete. It's like Intel paying Dell half its profits. Great until Dell starts making its own chips. Regulatory risk hasn't disappeared. It's evolved. New rules could mandate reserve compositions that reduce yields. Competitors might lobby for regulations that disadvantage Circle's model. International regulatory fragmentation could balkanize the stablecoin market. Finally, the bear case sees crypto correlation risk. Despite positioning as infrastructure, Circle trades like a crypto stock. When Bitcoin crashes, CRCL crashes. When crypto sentiment sours, Circle suffers regardless of fundamentals. The verdict. Both cases have merit, but the outcome likely depends on time frame. Short term, the bears are probably right. The valuation is stretched, competition is intensifying, and any disappointment could trigger a significant correction. Long term, the bulls have history on their side. Financial infrastructure companies that achieve critical mass tend to become monopolies. Visa, MasterCard, Swift. Once established, they're nearly impossible to dislodge. If Circle achieves similar positioning in digital dollars, today's valuation might seem cheap. The key variable is regulatory clarity. Clear, favorable rules make Circle a toll booth on the digital economy. Hostile or fragmented regulation makes them a feature, not a company. Investors are betting on the former, but the latter remains possible.
Standing at the helm of Circle today would feel like captaining a rocket ship that's either headed to Mars or about to explode on the launch pad. The potential is extraordinary, becoming the Federal Reserve of the Internet, the infrastructure layer for all digital value transfer. But the challenges are equally monumental. If we were running Circle, the path to $1 trillion in stablecoin market cap would start with a counterintuitive move. Embrace the competition. Rather than fighting Tether, PayPal, or bank stablecoins, position USDC as the interoperability layer. Build bridges, not walls. Make USDC the universal translator between different stablecoin ecosystems. When every stablecoin needs USDC for cross-platform liquidity, you win regardless of market share. Geographic expansion would focus on the edges, not the center. Everyone's fighting over the US and Europe. We'd go deep in Southeast Asia, Africa, Latin America, places where stablecoins solve real problems today, not theoretical problems tomorrow. Partner with local mobile money operators. Integrate with remittance networks. Make USDC the de facto currency for the 2 billion unbanked before banks figure out how to serve them. The product roadmap would extend beyond stablecoins into programmable money. Smart contracts that hold funds in escrow. Automated treasury management. Programmable compliance that makes money follow rules automatically. The opportunity isn't just digitizing dollars, it's making dollars intelligent. And A strategy would be surgical, not imperial. No more Poloniex-style empire building. Instead, acquire specific capabilities. A European e-money license, an Asian payment network, a DeFi protocol with unique technology, small strategic deals that fill gaps rather than big, flashy acquisitions that create complexity. The Goldman Sachs of crypto vision needs refinement. Goldman trades and takes risk. Circle should be more like the NYSE, a neutral venue where others take risk. Don't compete with customers. Don't trade against the market. Be the infrastructure everyone needs but no one fears. Here's the radical move. Open source parts of the stack. Make the basic USDC smart contracts public goods. Let competitors fork the code. When everyone's using your standards, you've won, even if they're not your customers. The value isn't in the code, it's in the licenses, banking relationships, and trust that can't be forked. On the regulatory front, we'd push for a two-tier system. Basic stablecoins with simple rules for small amounts, and institutional stablecoins with full compliance for large transfers. This creates a gradient of products serving different needs, rather than one-size-fits-all regulation that satisfies no one. The biggest strategic shift would be preparing for the post-stablecoin world. Stablecoins are a bridge technology between traditional and digital finance. Eventually, that bridge becomes unnecessary. Circle needs to evolve from building bridges to building the destination, the native financial system of the internet. This means investing in identity infrastructure, credit systems, and financial AI. When every transaction is digital and programmable, new forms of finance become possible. Continuous lending instead of discrete loans. Dynamic interest rates that adjust in real time. Insurance that pays out automatically when conditions are met. The cultural challenge might be the hardest. Circle has survived by being cautious, compliant, conservative. But $56 billion companies can't operate like startups trying not to die. It's time to play offense, not defense. Take calculated risks, push boundaries while staying within them. The final reflection brings us full circle to that family of four on the scooter. Except this isn't Mumbai, it's the entire global financial system, precariously balanced and desperately in need of safer, better infrastructure. Circle has built the first piece, a stable digital dollar. The question now is whether they can build the rest of the vehicle. The internet transformed information from atoms to bits, making it instant, global, and programmable. Circle is trying to do the same for value. They've proven it's possible. Whether they'll be the ones to complete the transformation remains to be seen. But here's what we know. The financial system will be rebuilt on digital rails. Value will move at the speed of light. Money will be programmable. The only questions are who builds it, who controls it, and who profits from it. Circle has a head start, but in technology, head starts guarantee nothing. The next decade will determine whether Circle becomes the Cisco of digital finance, essential infrastructure that investors ignore, or the Google of money, a toll booth on every transaction in the digital economy. At current valuations, investors are betting on the latter. History suggests the former is more likely. Either way, the journey from Bitcoin wallet to digital dollar infrastructure is one of the great pivots in technology history. Not because it worked, lots of pivots work, but because it required abandoning everything except the core insight. Money wants to be digital, but humans need it to be stable. Circle figured out how to deliver both. That might be worth $56 billion. Or $560 billion. Or nothing at all if governments decide private digital dollars are too dangerous to exist. Such is the nature of building infrastructure for a system that doesn't exist yet. Welcome to the future of money. It's going to be a wild ride.
This podcast is brought to you by Top, the stories of top companies. Disclaimer. This AI-generated content is for informational purposes only and should not be considered as investment advice.